Most people think Warren Buffett's greatest teacher was Benjamin Graham. They couldn't be more wrong. Today, you'll discover the one conversation that completely changed Buffett's investing philosophy and ultimately made him billions. Let's dive in.
People think the greatest investment lesson in my life came from Benjamin Graham. They're wrong. Benjamin Graham taught me how to buy stocks. Charlie Munger taught me how to own businesses. Without Graham, I probably never would have become an investor. Without Charlie, I never would have become Warren Buffett. For years, I believed I had investing completely figured out. I was finding stocks that everyone else ignored, companies trading for less than they were worth, businesses selling for 50 cents on the dollar. I wasn't looking for beautiful companies. I was looking for bargains. If I could buy a dollar for 50 cents, I was happy. That philosophy worked. In fact, it worked incredibly well. By the time I was in my 30s, I was managing millions of dollars. People thought I had discovered some secret formula, but they didn't know something that I refused to admit to myself. I was working much harder than I needed to. Every investment felt like another scavenger hunt. Every year I had to search for more discarded businesses, more forgotten companies, more cigar butts. That's what Ben Graham called them. Imagine walking down the street and finding a cigar someone had thrown away. It looked disgusting, almost useless, but there was one puff left, free. You'd pick it up, take that final puff, then throw it away. That was how I invested. Find a business so cheap that even if it wasn't very good, there was still one profitable puff left. The numbers worked, the math worked, but the businesses rarely did. Most of them were average. Some were downright terrible. I'd buy them because they were cheap, not because I wanted to own them. There is a huge difference. At the time, I didn't understand that difference. I thought investing was simply solving an equation, price versus value, nothing more, nothing less. Then one afternoon, Charlie Munger quietly dismantled everything I believed. Charlie didn't speak like most people on Wall Street. He wasn't interested in complicated formulas. He wasn't impressed by spreadsheets. He cared about something much simpler, the quality of the business itself. At first, I thought he was completely wrong. After all, Benjamin Graham was my hero. Everything I knew had come from him. Who was Charlie Munger to question that philosophy? Then Charlie asked me a question that I couldn't answer. Warren, why spend your life buying fair businesses at wonderful prices? When you could buy wonderful businesses at fair prices? It sounds obvious today. Back then, it sounded almost ridiculous. Pay more for a stock? That violated everything Graham had taught me. To me, a higher price automatically meant higher risk. Charlie saw it differently. He wasn't buying today's earnings. He was buying tomorrow's business. He cared about what the company would become over the next 20 or 30 years. I was focused almost entirely on what the balance sheet looked like today. The difference seems small. It isn't. It changes everything. For weeks, I argued with him. We debated late into the evening, sometimes for hours. Neither of us raised our voices. Charlie simply kept asking questions that slowly exposed the weakness in my thinking. He asked, "What happens after you've taken that last puff from the cigar?" I laughed. "You throw it away." Charlie smiled. "And then tomorrow, you have to go find another cigar butt." That sentence stayed with me because it was true. Every investment I made eventually forced me back into the same search. Find another cheap stock. Sell, repeat over and over and over again. Charlie wasn't trying to win an argument. He was trying to change the way I looked at the entire game. Instead of asking, "How cheap is this company?" he asked, "How good is this company?" I resisted for months, maybe because I was stubborn, maybe because admitting Charlie was right meant admitting I had spent years looking at investing through the wrong lens. And then a little candy company in California appeared on our desk. On paper, it looked expensive, far too expensive. In fact, if Ben Graham had been sitting beside me, he probably would have told me to walk away. Everything in my investing brain screamed, no. But Charlie looked at the same numbers and saw something I completely missed. That company was called Candies. And what Charlie saw inside that tiny candy business would completely change how I invested for the rest of my life and ultimately create tens of billions of dollars in wealth. When Charlie first mentioned Candies, I wasn't excited. Quite the opposite. I was skeptical. Here was a company that made boxed chocolates, no revolutionary technology, no patents that would change the world, no billion-dollar factories, just candy. And the owners wanted what I considered an outrageous price. My first instinct was simple, no. For years, I had trained myself to avoid paying premium prices for anything. A good investment in my mind began with buying cheap. See's wasn't cheap, not even close. The company's tangible assets were worth only a few $1,000,000. Yet the asking price was around $30 million. To me, it felt irrational. Benjamin Graham had taught me to look for hidden assets: factories, inventory, cash, buildings, things you could count, things you could sell if everything went wrong. See's didn't have much of that. What it had couldn't be measured on a balance sheet. Charlie understood that before I did. He looked at me and asked another question. Warren, if this company disappeared tomorrow, would people care? I shrugged. Probably. He smiled. No. They'd be heartbroken. At first, I thought he was exaggerating. Then we started studying the business more carefully. What we discovered surprised even me. Every Christmas, families lined up outside See's stores, not because the candy was the cheapest, not because it was the only chocolate available. They bought See's because it had become part of their lives. Grandparents bought it for their children. Those children grew up and bought it for theirs. Entire generations associated those little white boxes with birthdays, anniversaries, Mother's Day, Valentine's Day, and Christmas morning. People weren't buying chocolate, they were buying memories. That realization changed everything. For the first time, I saw something that never appeared on a balance sheet: brand loyalty. You can't touch it. You can't inventory it. But it might be the most valuable asset a company can own. Charlie understood something I hadn't. A truly great business doesn't have to fight for every customer. Customers come looking for it. Think about that. Most companies spend fortunes trying to convince people to buy their products. Advertising, discounts, coupons, promotions. See's barely had to. Its customers already wanted it. And here's where Charlie completely shattered my old way of thinking. He asked, what happens if cocoa prices go up? I answered immediately, the company makes less money. Charlie shook his head. Not if customers happily pay a little more. That sentence sounds simple, but it revealed something extraordinary. Pricing power. If a company can raise prices without losing customers, it possesses an economic advantage that most businesses never achieve. See's had it. Year after year, they increase prices just a little, not enough for customers to complain, just enough to stay ahead of inflation. Most people never even noticed. They walked into the store, smiled, bought another box, and left. No arguments, no resistance, no lost customers. That tiny annual increase became one of the greatest wealth-producing machines I'd ever seen. The business required surprisingly little additional capital. It didn't need to build massive new factories every year. It didn't need billions in research spending. It simply kept selling more chocolate at slightly higher prices to customers who already loved the brand. Then Charlie asked me another question. If you owned this business, would you ever want to sell it? That stopped me cold. I had never asked myself that before. My old investments were temporary. Buy, wait, sell, repeat. See's felt different. It wasn't a stock to trade. It was a business you wanted to own forever. That single realization completely reversed decades of my thinking. For years, I'd searched for bargains. Now, I was beginning to understand that paying a fair price for an extraordinary business could be far more profitable than buying an average business at a huge discount. Eventually, I agreed, not because I suddenly abandoned everything Ben Graham taught me. His lessons were still invaluable. Margin of safety, discipline, patience. Those principles would stay with me forever. But Charlie had added something equally important: quality. In 1972, Berkshire Hathaway purchased See's Candies. At the time, many people thought we had overpaid. Some investors couldn't understand why we would spend that much for a candy company. Looking strictly at the accounting numbers, they had a point. It looked expensive. But what happened next became one of the greatest investing lessons of my entire life. Year after year, See's generated more and more cash. Not because we reinvented the business, not because we made some brilliant operational changes. The company was already exceptional. All we had to do was stay out of its way. The profits rolled in. Those profits were then used to buy other wonderful businesses, which generated even more cash, which allowed Berkshire to buy even more companies. See's became something much larger than a candy company. It became the engine that funded Berkshire Hathaway's future. And suddenly, I realized Charlie hadn't just changed one investment, he had changed the entire direction of my life. But the biggest surprise wasn't how much money See's would make. It was what happened after I finally stopped searching for cigar butts and started searching for wonderful businesses instead. That decision would eventually lead me to investments almost everyone now associates with Berkshire Hathaway. companies like Coca-Cola, American Express, and Apple, and none of them would likely have happened if Charlie hadn't first convinced me to buy one small candy company in California. After we bought See's Candies, something unexpected happened. It wasn't just the profits that surprised me. It was how little we had to do. For years, I had been chasing opportunities that required constant attention. One undervalued company after another. Every investment came with a new list of problems to solve. Management issues, declining industries, weak balance sheets, hidden risks. Every cigar butt eventually burned out. Then I'd have to start the hunt all over again. See's was different. Customers kept coming back. Managers kept running the business exceptionally well. The company quietly produced cash year after year without demanding endless amounts of new investment. That was the moment I finally understood what Charlie had been trying to teach me. The best businesses don't consume your capital. They create more of it. That may sound obvious, but for decades, I had focused almost entirely on what I was paying. Charlie was focused on what the business could become. There's an enormous difference. One day I looked at our financial statements and realized something extraordinary. The money flowing out of See's was buying entirely new businesses. One investment was financing the next one. Then that investment began producing cash, which financed another. The compounding wasn't happening only inside the businesses. It was happening inside Berkshire itself. The machine had started building itself. That's when I stopped asking, how cheap is this stock? Instead, I began asking, if I owned this business for the next 20 years, would I still be happy? That simple question eliminated thousands of potential investments. I no longer cared if something looked statistically cheap. Cheap companies often stay cheap. Sometimes they become even cheaper. A struggling business can consume enormous amounts of capital while giving very little back. A wonderful business often does exactly the opposite. It quietly sends cash back to its owners year after year without asking for much in return. Charlie liked to say, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Today, people repeat that quote all the time. Back then, it completely changed the way I invested. Looking back now, I realized Charlie wasn't asking me to abandon Ben Graham. He was asking me to build on Graham's foundation. Benjamin Graham taught me how not to lose money. Charlie taught me how to make extraordinary amounts of it. Those are two very different skills. Not long after See's, another opportunity appeared. It wasn't candy. It was something almost every American recognized, the Coca-Cola Company. Now think about that for a moment. If the younger version of me, the Warren Buffett from the 1950s, had looked at Coca-Cola, he probably would have passed. Why? Because it wasn't statistically cheap. It wasn't selling below liquidation value. It wasn't a forgotten company hiding in the back pages of financial reports. It was one of the most recognizable brands on earth. Millions of people drank Coca-Cola every single day. Most investors looked at that popularity and assumed all the opportunity had already disappeared. Charlie and I looked at something else. We looked at human behavior. Walk into almost any restaurant in America. What do people order? Go to a baseball game, an airport, a movie theater, a family barbecue. What do you see? The product had become part of everyday life. More importantly, people weren't switching because another cola cost 10 cents less. That kind of loyalty is incredibly rare. It's also incredibly valuable. We weren't buying a sugary drink. We were buying one of the strongest brands ever created. One that could raise prices. A penny here, a nickel there, without customers walking away. That tiny pricing power, repeated across billions of servings, creates astonishing wealth. Again, Charlie had been right. Wonderful businesses don't have to win every customer every day. They've already earned something much more valuable. Trust, habit, recognition. Those things are almost impossible for competitors to copy. Around the same time, I began looking differently at another company, American Express. Most people remember the credit cards. What fascinated me was something deeper. People trusted that name with their money. Trust isn't listed on a balance sheet. Neither is reputation. Neither is customer loyalty. Yet those invisible assets often become the most valuable part of the business. That's another lesson Charlie helped me see. Accounting tells you what a company owns. It doesn't always tell you what makes the company exceptional. Some of the greatest businesses in history look expensive until you understand why customers refuse to leave. That realization changed nearly every major investment decision I made afterward. It influenced Coca-Cola. It influenced Moody's. It influenced Apple. It influenced dozens of businesses that generated extraordinary returns for Berkshire shareholders. People often ask me, what was your greatest investment? Many expect me to name Coca-Cola or Apple or American Express. But if I'm being truthful, those investments became possible because my way of thinking had already changed years earlier. The real investment wasn't C's, Candies. The real investment was changing my own mind. And changing your mind isn't easy, especially when the old way has already made you successful. Success can become the biggest obstacle to future success. That's something very few people understand. Most investors don't fail because they're unintelligent. They fail because they're unwilling to question ideas that once worked. I was fortunate. I had someone sitting beside me who wasn't afraid to challenge me. Charlie never cared about winning arguments. He cared about finding the truth, even if it meant proving his best friend wrong. And thank goodness he did. Because there was one final lesson Charlie taught me. One lesson that had nothing to do with stocks and everything to do with building a remarkable life. It may have been the most valuable lesson of all. Part 4. When people look at Berkshire Hathaway today, they see one of the most successful companies in history. They see hundreds of billions of dollars. They see investments that multiplied many times over. They assume there must have been hundreds of brilliant decisions. The truth is, there were only a handful. Most fortunes aren't built by making thousands of great decisions. They're built by making a few extraordinary ones and then having the patience to let time do the heavy lifting. Charlie understood that long before I did. He used to tell me, the big money isn't in the buying or the selling. It's in the waiting. That's much harder than it sounds. Wall Street rewards activity. Television rewards predictions. The financial industry rewards movement. Someone is always telling you to buy. Someone else is telling you to sell. Every day, there's another can't miss opportunity. Another hot stock, another market forecast, another expert who claims they figured it all out. Charlie and I never believed that game. In fact, we tried to play a completely different one. People often ask what our competitive advantage was. They expected us to talk about financial models, research teams, technology, inside knowledge. Instead, our advantage was surprisingly simple. We were willing to sit still. Imagine watching thousands of pitches fly past you. The crowd is screaming. Everyone else is swinging. Some are celebrating, some are striking out, but no one notices the person who quietly keeps the bat on his shoulder. That's how investing looks to me. You don't have to swing. No one can call a strike. You simply wait until the right pitch finally comes. Charlie loved that idea because it removed emotion from investing. Patience stopped being passive. It became a competitive advantage. Looking back, I realized Charlie gave me something far more valuable than a new investing strategy. He gave me permission to evolve. That's surprisingly difficult, especially after you've spent years being rewarded for doing something one way. Human beings naturally defend their own ideas. We become emotionally attached to them. The longer we believe something, the harder it becomes to let it go. I wasn't just changing an investing strategy. I was changing part of my identity. Benjamin Graham had shaped my entire career. Admitting Charlie had found a better way wasn't easy. But that's one of the greatest lessons I've ever learned. Your best ideas should always be temporary. The moment you stop learning, you stop growing. Charlie challenged me constantly. Sometimes he'd tell me I was wrong before I'd even finished explaining my idea. He wasn't trying to embarrass me. He simply cared more about the truth than he cared about being agreeable. Everyone needs someone like that. Someone who isn't impressed by your success. Someone who asks uncomfortable questions. Someone willing to tell you what you need to hear instead of what you want to hear. Those people are incredibly rare. When you find one, hold on to them. Charlie wasn't just my business partner. He was my intellectual sparring partner. For more than 60 years, we challenged each other, questioned assumptions, tested ideas, changed our minds. People assume we agreed on everything. We didn't, not even close. Some of our longest conversations started with complete disagreement. But we both understood something important. Disagreement isn't dangerous. Ego is. If your goal is to prove you're right, you'll eventually stop learning. If your goal is to discover what's true, you never stop improving. That mindset shaped Berkshire Hathaway more than any investment ever could. People often ask me, if you could go back and give your younger self one piece of advice, my answer surprises them. I wouldn't tell myself to buy more Coca-Cola. I wouldn't tell myself to invest in Apple earlier. I wouldn't even tell myself to avoid some of my biggest mistakes. I'd simply say, Listen to Charlie sooner, because changing how I thought was worth far more than any single investment. See, Candies wasn't just another company. It became proof that quality compounds. A wonderful business can quietly create wealth for decades, long after everyone has stopped paying attention. That's exactly what happened. The cash C's generated helped Berkshire buy more wonderful businesses. Those businesses generated even more cash, which funded even more investments. One good decision became another, then another, then another. Compounding isn't just about money, it's about decisions. A single better idea, repeated over decades, can completely change the direction of your life. That's true whether you're investing, building a business, or simply trying to become a little wiser every year. When Charlie passed away, people asked me what Berkshire would be without him. The answer is simple. Berkshire exists because of him. Yes, I've found many of the investments, but Charlie changed the lens through which I saw every investment afterward. That's a gift very few people ever receive, and it's one I'll spend the rest of my life being grateful for. So if there's one lesson I hope you remember from this story, it isn't about candy or stocks or Berkshire Hathaway. It's this: never become so successful that you stop being teachable. The greatest investment I ever made wasn't in Coca-Cola. It wasn't in Apple. It wasn't even in See's Candies. It was investing in a partnership with someone who wasn't afraid to prove me wrong. That decision earned me something far more valuable than money. It gave me a better way to think. And once you learn to think better, everything else becomes easier. Do you agree? Let us know what you think in the comments below.
Oh, wow. Another gold mine from the master of investing. Now it's your turn. What's the biggest investing mistake you've ever made, or the biggest lesson you've learned? Share it in the comments below. I read every comment, and your story could help someone else become a better investor. See you in the next one.